Hi, folks. Welcome to the Weekend Investing Stock Market Weekly Review for the week ending 21st of November. Lot of action this week. For the first, I would say, 4 days, there was strong rumors that India-US tariff deal is almost through. And then something happened on Friday where the USD INR went through the roof, nearly 89.6. And the market chatter is that RBI sort of let it go. It didn't, it had been supporting that level of 88.5 since a while. And as Asian currencies were dipping versus the dollar in the last few days, RBI finally had to let go and allow the rupee also to be in line with other Asian currencies. The Japanese currency, especially, is under extreme pressure as Japan is about to unleash a massive stimulus to their economy. Uh, Certainly, it risks that the Japanese yen is going to crack hard versus the dollar, and that has a rub-off effect on other Asian currencies. Um, the other impact, of course, has been this tech meltdown that we are seeing in the US. Tech meltdown, crypto meltdown, all that is also causing some outflows from India, and that also probably is adding pressure uh, to the rupee weakening. So, all in all, we are again, nowhere in terms of the tariff deal. We are vulnerable in terms of the currency slipping hard, and in terms of the Asian crisis, I shouldn't call it Asian crisis, but other Asian countries currently dealing with uh, situation like Japan, that can also have a regional impact going forward. So suddenly, with good tailwinds, we have now come to some headwinds in the market. A few days back, we were thinking of new highs on Nifty, which is still possible, but the broader part of the market is not supporting the Nifty, and we will see that in the charts in this video. So please stay on till the end of this video, and you will get some insights about how the market is behaving. From our research desk this week, we had these fantastic stories why different sectors perform differently every year, why all-time highs matter in the market. Nifty and China look at different markets and how they perform versus each other. Strong rise in gold ETF demand in India, one case study on that, and a simple look at how big US companies compare to global markets. That completes the sort of research desk outcome for this week. Disclaimer as always, please read this fully uh, and do understand the disclaimer and then move forward in the video. And of course, do subscribe to the channel if you like this content. Nifty on the daily chart has uh, sort of clipped the top end of this range that we've had since July, uh, and has gained 0.61%. This is the weekly chart. So on the daily chart, however, it may seem that it is resting here or consolidating here, but on the weekly chart, you can see that Nifty has actually closed at a almost a yearly high, uh, at a 52-week high, in fact, and we are at stone's throw from the previous high. We have taken support on this trend line. So, from a formative point of view, there is no damage on Nifty. Nifty is, in fact, looking extremely good to go for a new all-time high. However, there are headwinds in the other parts of the world. S&P 500 has a fourth red candle week this week, minus 1.95% this week, while the damage is not so evident on the S&P 500, but the damage is extremely evident when you go to S&P 100 top 100 stocks or Nasdaq. The big names like Oracle, AMD, uh, even Palantir, which had been running around, have gotten hurt this week. Gold is up 0.63%. So gold also, it's gradually making a base here. It is not falling, which is a good sign, because after this kind of a run up, if you have a even 3 months of consolidation, that's no big deal actually, because then that is sort of telling you that it is creating a base for the next move up. Dollar index is rising and has been rising this week, and that is primarily the cause of weakness in most emerging markets, and uh, and the flight towards the dollar is increasing again, and that would put pressure on emerging market currencies. Global indices overview in dollar terms. So this is a unique chart which we create across the globe in dollar terms. And this week, no market was spared. In fact, Hang Seng was down 5.3%, Nikkei was down 5%, Euro stocks, DAX Germany, Brazil, all down 3.8 to 4.2%, Australia 3.6% down. So, from all these perspectives, India has been spared at minus 0.3%. If we see the momentum score across countries, so Brazil is at the top, then you have Canada, then you have US, then you have India. So Nifty has moved up dramatically. Nifty was in position 13 or 14 recently. So Nifty has moved up. However, Nifty 500 in this series of index is still in the bottom quadrant, and that is showing you the divergence between Nifty 50 and the rest of Nifty 500. This scoring is showing you that kind of divergence that is already happening. When we look at the benchmark indices this week, Nifty eked out a gain of 0.6%, but the broader part of the market, including other large caps, were quite massively down between 1% and 2%. If we see the sectoral overview, only IT stocks gained 1.6%, autos gained 1.1%, minor gains in consumption stocks, minor gains also in uh, tourism and services sector, but big falls in real estate. This is surprising because real estate, metals, commodities, and defense, these have done well in the past. So a big sort of profit taking event is happening here. And perhaps, just perhaps, maybe this is also a sign that the interest rate expectations that the market had are sort of going away. That we'll get a nice juicy cut in the coming RBI meet. I think with the currency cracking very hard, perhaps that is taking a backseat right now. So when we see the momentum ranking across sectors, we can see PSU banks are still at the top, although in the last 1 week they have lost the leadership here. Uh, Autos are the next, capital markets, banks, infrastructure, oil and gas. These are the top five sectors where average bullishness is more than other sectors. Although in the very short term, IT has moved up. In the very short term, consumption stocks have moved up relatively. So even if IT consumption stocks may not be moving up absolutely, but relative to other sectors, they are performing better in the very short term. So this heat map score actually tells you where one sector is versus the other on average basis across different time frames. In the weekly advance decline stats, very poor advances in all segments except Nifty. So you can see the stark nature of the Nifty move versus the rest of the market. Nifty is 63% advances, others are between 20 and 22 and 29% advances. So completely two worlds are right now playing, Nifty in one corner and the rest of the market in the other corner. In the market cap segment wise drop from 52-week high table, you can see 53% Nifty stocks are less than 10% down from their tops. And if you add the 10 to 20% bracket, you almost have 70% stocks which are less than 20% down. Whereas rest of the market has probably 50 to 60% which are 20 to 50% down. So completely different uh, playbook that is happening in different parts of the market here. In the percentage of stocks outperforming the benchmarks, there is CNX 500 has only 32% stocks which are outperforming the CNX 500 benchmark. So very, very few likely Nifty stocks which are part of CNX 500 are outperforming the benchmark. There is nothing notable in the other indices this week. In the strength and weakness section, in the golden cross, you have 73% Nifty 50 golden cross, Nifty next 50 is 72%, which is very good. And in fact, the 50 DMA being above 200 DMA is reasonably good across all sectors. So, from the point of view of long-term weakness, we still have reasonable bullishness in across sectors. However, when you look at brutal strength, then 31% stocks are showing brutal strength, which is price greater than 25, greater than 50, greater than 200 DMA. And less so as you go down. Small caps and micro caps are extremely low at 13%. And you can see here in the brutal weakness, you have significant number. One third of the market in micro cap is under brutal weakness. One fourth of the small cap market and CNX 500 are in brutal weakness. Brutal weakness is where you don't want to be in that space, and only 10% of your five stocks of Nifty are in the brutal weakness space, and some of them are ICICI Bank, NTPC, Power Grid, Trent, and TMPV. In the Nifty next 50 space, these are the stocks which are in brutal weakness, where ideally you should stay away from these stocks till they come out of brutal weakness. Is the trend improving or declining? So if you look at the 50-day moving average trend, then only 43% of CNX 500 stocks are above 50-day moving average, which is getting poorer. It was nearly 50% a month ago. And on 200-day moving average also, it is tending to decline, although there is no sharp dip as such. But only 52% stocks above 200 DMA is not a great picture. So the entire market is supported only by a few stocks in the Nifty. Rest of the market is taking a backseat. If we see the trend check amongst sectors, where are the shorter term moves happening? So PSU banks have 100% stocks which are above 50-day moving average. So all PSU banks are showing some sort of bullishness, and within that sector, most likely you will get the best buying opportunities or buying setups. Private banks are also not too far back at 80%, metals at 73%, autos at 71%. So these are the 3-4 sectors where significant number of stocks are showing some bullishness. And when we compare it to 200-day moving average, then a lot of sectors have 70, 80, 90% stocks above 200-day moving average, which is good. But the market average at 52% is very poor. 52% stocks, top 500 stocks above 200-day moving average, and 48% are below 200-day moving average, tells you how bad the situation is in the market. In the FII DII segment, FIIs have sort of reduced their volumes in terms of inflows and outflows. We had some minor up days, some minor down days, some reasonably bigger up days and down days, but overall, nothing really big in terms of inflows or outflows. DIIs continue to have good inflows, 2 days of good inflows, 3 days of mediocre inflows. And when we see the monthly figure, cumulative monthly figure, FII in the last 1 month have removed 15,000 crores from the market, which is not such a big number, whereas DIIs have put in 80,000 crores into the market in the same time frame. So markets are well supported by domestic money, but FII money continues to go out, although on a very gradual basis. So that's where we are in terms of this week's weekly review. Do keep sending us feedback how you like this report, what all you may want to add in this report. Do give us your suggestions. We will certainly try to improvise and incorporate those features. If you don't like some of these metrics, please do let us know. We are certainly very flexible in terms of trying to offer you the metric that you would like to see on this report. And certainly, if you wish to connect with us, you can always drop us an email at support@weekendinvesting.com. Thank you so much. Bye bye.